What's up, everyone? It's Scotty with MoneyVest. Welcome on board for our Jerome Powell Federal Reserve speech live stream. And of course, in less than an hour, we've got Jerome Powell coming online with the press conference. And in under 30 minutes, we'll get the statement of the summary of economic projections not coming out in January, so that's going to be coming out in March. But of course, we will have the statement from the FOMC as well. Mohit, thank you so much for the donation, brother. I really appreciate that. And again, if you have any question, let me know. I will be taking a lot of questions from anybody who does participate. So again, thank you so much, brother. I really do appreciate you, and we're ready. So again, the audio, the video, if everything's working well, just give me a thumbs up and we should be all set. Nasdaq definitely selling off, so it's down a little bit over 1.2%. So we're definitely seeing a little bit of pullback in a lot of individual stocks, including the likes of big tech. So Google here selling off over 6%. I've got a video coming out on Google later today. AMD down over 2.5%. Nvidia pulling back finally. We've got Microsoft down over 1.3% on the back of earnings. Amazon, Meta also down over 1%. Apple basically flat, slightly down about close to 1% here. And Tesla, Netflix slightly higher, with Enphase also pushing up over 3% on the day, back over $109 per share. So once again, thank you so much for joining us. Bro, you're welcome. Thank you for keeping me informed. Thanks a lot, Mohit. I really appreciate that. And again, this right here is going to be the 2024 meeting calendar. So today is January 31st. Today is the first meeting of 2024 from the FOMC, from the Federal Reserve Open Market Committee. And March, of course, is the next meeting, March 19th and 20th. And that's when the summary of economic projections comes out. April and May. So that's going to be April 30th. And May 1st is when the following meeting is. Then we got a couple meetings in June and July. September, November 6th and 7th. So literally on my birthday this year, November 7th, is when the FOMC meeting is going to take place. And then, of course, December 17th and 18th is when we also have another Fed meeting. So all in all, we've got 1, 2, 3, 4, 5, 6, 7, 8 meetings for 2024, with starting with today being the first meeting for the Fed. Now, this right here was the summary of economic projections from the previous December meeting. So December is when we got the SEP last. And as we already know, the Federal Reserve's already penciled in about 3 rate cuts in 2024. So we basically are looking at 5.4% as being the current terminal rate, and that rate's going to drop down to 4.6%. So that's going to be about a 75 basis point cut for the interest rates for the federal funds rate. And if there's any sort of changes in this federal funds rate, I think that's really what the markets are looking for. Those are the type of clues that we're going to try to get from the Federal Reserve's meeting today as well. So again, this is where the live is going to take place in less than an hour. We do have the poll right now. So by the way, do share this live stream. All I'm asking from all of you is to really just drop a like, subscribe to the channel if you haven't already, and just one more thing, which is share this live stream with anybody else who you think might be interested in joining us. And of course, listening to Jerome Powell when he starts talking during that press conference as well. So and again, do participate in our poll as well. We've got 150 votes, but definitely do participate what you think the market's reaction will be after Jerome Powell speaks. So whether that's going to be bullish, bearish, or neutral. Right now, we've got a 39% bias towards bullish momentum after Jerome Powell's speech, and 35% is going to be bearish as well. We want bearish, but it will be bullish. Not allowed to say. Stefan says, it's been a while. Can you take a look at Nextera Energy, highly profitable company, and how rate cuts can hugely affect it? So yes, we'll take a look at Nextera Energy here as well. Let's see. So yeah, Nextera Energy we'll take a look at. I'm going to break down some of the Magnificent 7 companies first, and then we'll circle back over to everyone else's stock analysis, and of course stock questions specific to each company. But first things first, let's go over to tech, because technology, of course, has seen a lot of momentum. Apple saw a very nice move back higher from that 200 simple moving average. So this right here is the entire analysis. We got a nice bump from that 200 SMA, 9% rally back higher, and it's now starting to roll right back down. Now, Apple and Microsoft kind of lead the market a little bit, specifically tech. They lead technology sector. And if they start rolling over, if they start showing signs of weakness, it's more than likely that other sectors also participate. Other stocks within the technology sector also start to roll over as well. So Microsoft, as you'll notice, from highs of $414, and today such an aggressive intraday reversal, right? So if you come over to the 5-minute chart, you'll notice this right here is quite interesting, that it kind of hit a new all-time high almost at $415, and then it sold down over 3% intraday, selling right back down, and just an incredible candle coming back down with the RSI MACD also, of course, showing signs of overbought levels and starting to roll over as well. And then, of course, not to mention Amazon, we've got Meta, we've got Google, we've got AMD, Nvidia here. A lot of these companies starting to show some signs of a potential pullback on the day here. So, so definitely do join us with those polls. Definitely do participate. And like I said, less than 30 minutes, less than 20 minutes here for the statement to come out. And the only thing the market's going to be looking for here is a pause, right? So pause is what the market wants. January 31st, that's where the interest rates are expected to be. 96% probability that the Federal Reserve is going to keep rates unchanged exactly where they are. And as soon as the statement comes out, the first thing we're going to be reading immediately is where the interest rates are going to be. So in support of these goals, the committee decided to maintain the target range of the federal funds rate. This right here, this is the number that we're going to be reading right at 2 p.m. Eastern. And right now, of course, it's 5.25% and 5.5%. That's exactly where we are, 5.25% and 5.5% at the moment. So if this statement remains unchanged, that means rates are unchanged. They are where they are. But of course, if there's any changes to this right here, if it goes up to 5.5 or it comes down to 5, then we know that there's been a rate hike or a rate cut from the Federal Reserve. But of course, a 96% probability that rates are going to stay unchanged. So in my opinion, that's really what we are expecting. People are too bullish and talk about Palo Alto Networks. So when it comes to cybersecurity, I think one really can benefit from looking at CIBR. CIBR is a stock that, I started dollar cost averaging into in the low 50s, and I believe I'm up a little bit over 7% on this ETF. This has all of your cybersecurity companies like Zscaler, Palo Alto Networks, CrowdStrike, Fortinet, Okta, Ping Identity. Like there's a lot of companies that are part of the cybersecurity ETF. I think there's over 30 stocks in this ETF, and decent dividend yield. Year to date, it's up over 6%, and decent volume as well, over 500,000 shares traded every day. So this is an ETF that I am again starting a new experiment in, along with VUG and SMH. So I will be buying more and more of this ETF over time. But when it comes to individual cybersecurity stocks, no doubt a lot of them have absolutely crushed it in the last 1 year. I mean, Palo Alto Networks in the last 1 year is up 114%. CrowdStrike has also hit a new all-time high in the last 1 year. This stock's up over 192%. It's kind of crazy sometimes. You look at it in hindsight. We took a trade. I remember this time here in January of 2023, so earlier last year, literally in the beginning of last year, we had a swing trade on this, right? So we had a swing trade with a 15% profit margin and a risk of just under 3%. It's kind of crazy. You go back, we did a members only video. We talked about this on YouTube as well. And, I took my profits 15%, 20%. I was happy and I was out. And of course, you take a look at how much it's gone up from those levels, almost 200%. So, but sometimes, obviously, you're going to miss out on these moves. Like it could have been the other way around as well. It could have hit that target of $108 and then would have dropped like another 60% and could have gone the other direction. So, but of course, as they are turning the corner towards profitability, as a lot of companies are in cybersecurity, so you can see that CrowdStrike, since the first quarter of 23 has really just turned things around towards profitability and is now generating some decent good profits. Margins have also expanded, and that's been reflected in the price as well. Fortinet is struggling a little bit, or in fact, it has recovered really well from lows of about $44, $45. We did analysis on Fortinet, and this is, in my opinion, one of the highest quality stocks when it comes to cybersecurity. And literally, if you take a look at from those low 40s inside this green rectangle, it has rallied over 50% from those levels. So really well done price action for Fortinet as well. Oscar, thank you so much for the donation. I really appreciate that. If you have any questions specifically, let me know. So I already covered Palo Alto Networks for you, but I can do a little bit more detailed analysis. And the idea here is, again, you want to be looking for companies that have a lot of long-term potential, right? If you are investing in those companies long-term, you always want to look for a few things: a very strong balance sheet, very good profitable earnings, and positive cash flows, right? So that's kind of like our philosophy on the channel at MoneyVest, is like we're not looking for speculative penny stocks. We're only looking for high quality businesses that actually make sense for the long term, that are solving real world problems and are generating good cash flows and earnings. And Palo Alto Networks kind of fits that criteria. And the fact that they've turned the corner towards profitability is even better. And if you come over to the valuation, that's the only concern that I may have is, okay, it's trading at 16 times sales, almost 200 times earnings. So how comfortable are you paying those types of valuations here? But net debt is negative 1.6 billion. So fantastic balance sheet, more cash than debt, and earnings expectations are also pretty solid from 551 to over 787. So I do believe that, okay, a lot of the sort of future potential has been priced into the stock here. Technically overbought from an RSI MACD standpoint. So support level now is going to be 257. There's actually going to be another support level to watch right over here at $280. So those right there are going to be a couple levels to watch for Palo Alto Network. And again, pretty much at an all-time high right now. So that's where we are. So again, if you have any questions, folks, just let me know why Google and AMD got hit so hard after earnings. Good earnings overall and good AI-driven outlook. AMD recovered a little and is overvalued compared to Google. What is Wall Street not liking? So I think, I have a video coming out on Google here later today, but I do believe the cloud revenue was a little bit slower than what analysts were expecting. But even then, they grew the cloud revenue by 23%. What do analysts really want? That's one of the things that I've kind of mentioned, is that analysts have a very, very short-term outlook, right? They're only looking on a quarter-over-quarter basis. Very rarely you'll find analysts kind of covering the stock from a long-term perspective, and looking at price targets 5 years, 10 years out, because most analysts, what they do is that they've put a price target on a stock 12 months out in a year. And that 1 year target is based on the next 4 quarters worth of earnings. And if those 4 quarters worth of earnings are not great, if they report, let's say, a slower growth, or the earnings are declining on a year-over-year basis, or the companies are not doing super great, what's going to happen, right? They're not going to be part of the portfolio. They're not going to be part of the coverage for that Wall Street firm or whatever analyst is covering it. So, that's exactly what's happened with, I believe, Enphase, right? Enphase has gone through a slowdown in the overall growth rates, even though the company is growing. That's the crazy part. Even though the company is growing, just because it's growing at a slower rate is what Wall Street doesn't like. And remember when 2022 was the year, what was the sector that did really well in 2022? When we had the bear market in 2022, what was the one sector that did incredibly well? I want to see how good everyone's memory is. I want to see if anyone remembers which sector performed the best in 2022 when the entire market was going through a bear market. We saw technology stocks sell off pretty aggressively. We saw so many companies got dropped like 40, 50, 60%. But what was the one sector that did incredibly well? Not only was it up, it was just phenomenally energy, right? Perfect. Energy. Energy was one sector that did incredibly well in 2022. How did it do in 2023 compared to technology? Really bad, right? Compared to technology, tech did incredibly well. So it's, this idea from Wall Street is energy stocks had earnings growth of over 150, 200%. I still remember going over, doing those videos of S&P 500 earnings breakdowns, and energy was at the top of the list because oil prices were so high. Energy companies were spiking, prices left and right, and we saw incredible growth on a year-over-year basis. As a result, energy stocks had the best year. Fast forward to 2023, when oil prices stabilized, they dropped over 30, 40%. That reflected in the earnings for energy companies. And year over year, they didn't grow as much. Technology, which was already coming off of a pretty brutal earnings season in 2022, recovered, and year over year comps were really good. And Wall Street loved that. And as a result, 2023 was all about tech. Now, 2024, right, I do believe semiconductors are going to cool off a little bit because NVIDIA can't be growing at 400, 500%. It's not going to last forever. Every company that goes through these big cycles of growth eventually starts to normalize, right, because comps become more and more difficult, and AMD included. I'm not saying NVIDIA is the only one. AMD included, Supermicro included, ASML included, TSMC, a lot of chip stocks, Lam Research, you look at Applied Materials, even Qualcomm. There's a lot of companies that have done really well when it comes to semiconductors. So I think that sector has become a little bit overcrowded. Technology's become a little bit overcrowded. I do think that if Enphase and PayPal, both very strong companies, can report some good year-over-year numbers, earnings-wise, then there's a lot of potential for them to be loved by Wall Street again. Same thing happened with Meta, right? Meta reported numbers in 2022. Earnings year over year were not that great. 2023 comps were easier. They reported stronger numbers, and boom, 400%, 200, 300% recovery back up to all-time highs. So Wall Street does have a very short-term outlook. Orange juice 2022. Orange juice has actually done really well, surprisingly well. Orange juice has actually been one of the best performing commodities over the last several years. So if you come over to OJ, if you come over to orange juice, it has done phenomenally well. If you go over to the monthly chart since 2019, like just think about it. Go back to before the pandemic. Okay, if you all could go back in time, and we could go back to the point where before the pandemic, we're in 2019, we're just strolling down the street. We don't know Caddy, we don't know Moneyvest, we don't know each other. We're just like, orange juice was the play. Orange juice was the trade, because since then, it has gone up 300%. Incredible gain, right? I mean, of course, Tesla's beaten that gain. Nvidia has outperformed that gain. But the point is that orange juice actually did really well during that time. OJ will never be crowded. OJ has been killing it. It really has been, right? I mean, it says, I believe this is price per ounce. I could be wrong, but from 85 cents to now well over $3.60 with a high of $4.18. So frozen concentrated orange juice prices are surging. When are they not? When are they not surging? They feel like always they're pushing higher. But absolutely incredible move. Okay, so can you please run the technicals on Mara stock, Emma? Let's take a quick look on Mara here. So what I have here for a resistance on Mara is going to be all the way up here. That's going to be $51 per share, and a much more reasonable and closer resistance at close to $29.45. So that's going to be another resistance to watch. And I'd watch a decent, but again, it depends very much on how how Bitcoin prices are doing. So Bitcoin has a big role to play for Marathon Digital. So there's going to be a support at around 15, I would say 15.21. That's exactly where it's bounced off of more recently, and a resistance and targets back up to 29, close to $30. Okay, so yeah, SoFi is near the bottom, judging by the sentiment. So of course, I mean, it's done really well in terms of the profitability that it's shown recently. So that's again pretty solid. I did a video on SoFi yesterday, so definitely do check that out. By the way, folks, do drop a like on this live stream. I would really appreciate that. 85 likes, and we got over 400 people watching. So we're gonna be here for a while, at least for the next couple hours, because we've got the statement coming out in 10 minutes. I'll break that down, and then we'll listen to Jerome Powell in under an hour. So definitely do drop a like. Let's see if we can at least get up to over 200 likes, because that really helps out with the algorithm, pushes this live stream out to more people that might be interested in joining us. So Nexera Energy, this right here is the entire sort of analysis that I've already done on Nextera. So we've got a resistance and a target up to $67, $68. So that is going to be that level to watch, and a support at around $50, $51. That was kind of aligned with where we were during the pandemic. So if you kind of bring down this support a little bit, you'll notice that that's exactly where we were before bouncing back higher from those levels at around $47, $48. So we're kind of in the middle right now, a pretty decent bounce, 22, 23%. But I'd be watching that as the next resistance for Nexera Energy. But overall, I think this is a pretty solid dividend stock as well, over 3% dividend yield. The balance sheet is the only thing that's concerning for Nexera Energy, as I've mentioned before in my previous videos. The company does have a net debt of over $70 billion, so plenty of debt relative to the cash, $73 billion in debt alone, and earnings expectations are modestly growing all the way to $4.31. So it is a, I would say, good quality company that we have analyzed before. It's a dividend stock. But the balance sheet is the only thing that kind of concerns me a little bit. Okay, Kajal, Kimcho Caddy, please take a look at SYM, DIS, so Disney also C Limited, but the fair value is actually above 50, Etsy, so let's take a look at, so I think fair value for Nexera is going to be in the low 40s, I believe. So there we go, I had it over here from a while ago, fair value and a good deal in the low 40s, is what I mentioned before for Nexera. So The thing about intrinsic value that I think everyone needs to understand is that these are not predictions. Like these are, how analysts put a price target on a stock. That price target is indeed a prediction. Like they're telling us that, okay, this is the price target. This is where they see the whatever stock they're analyzing to get up to within that time frame, whether that's 1 year, 6 months, whatever. That's where they expect the price to be in that time frame. The opposite of that is what I'm doing is calculating the intrinsic value, right? What's the company actually worth? What's the stock actually worth today in present based on all future cash flows? We're calculating the present value of all future cash flows for the next 5 years or 10 years, cash flows or earnings or profits, and then discounting them back to present value. And this is the sum of all those future earnings and cash flows. And this is what I believe the true intrinsic value for that stock is today based on these assessments. So just because I've got a fair value of a stock at, let's say, 50 or 60, doesn't mean the stock's going to come down to that level. That's not a prediction, right? It's simply the true intrinsic value of that stock. If it comes down, that's where it should be valued at. If it's trading below the intrinsic value, that's when it becomes undervalued, right? And if it's trading above that intrinsic value, that means it's trading at a premium. It's trading at an overvalued level. But another thing that we have to understand is that valuations are subjective, right? What I may consider to be overvalued, you might consider to be undervalued, and vice versa, right? So we can never fully agree on the valuation of anything because it just really depends on, the person to person, right? I forgot what that saying goes, the value is in the eye of the beholder or something, right? Because, just like art is very subjective, and it really depends on who's looking at it and how enthusiastic you are with that piece of art. Just like that, that's how most things work. But with stocks, of course, we do have some fundamentals, some financials to analyze, some metrics to look at. But even then, who's to say that Google at 24 times earnings is overvalued and 18 times is undervalued, right? Just depends on a lot of other market variables. So that is something to keep in mind. What is Tesla's intrinsic value? For me personally, considering only the electric vehicle business, I put a fair value close to 150s. But I know that a lot of people would somewhat disagree with that fair value, and that's okay because everyone's got their own approach of kind of evaluating a stock. But for me, I think 150 is a lot better, a lot reasonable price point to be looking at Tesla just from an electric vehicle standpoint. And if everything else kind of materializes, if the company becomes very solid in AI, robotics, electric solar panels and whatnot, then of course that's the cherry on top, right? Then it could be 200, 250, 300, 400, but that's the cherry on top, right? That's not something that I would be betting on, right? I'd much rather be conservative and right than be aggressive and wrong. Always remember that line, right? Always remember that one line. You'd much rather want to be conservative and right than be aggressive and wrong. Because if you're aggressive and wrong, your portfolio can be destroyed. If you're conservative and right, you are going to be more successful in terms of creating that consistency over time. So really, really important thing. One man's trash is another man's gold. You're so dedicated to teach, patient, humble. Really appreciate Stefan. Thank you so much. I really appreciate that. Bullish or bearish on FOMC. So 408 votes. We're trying to get to 1,000 votes today, folks. So definitely vote and participate on the poll. What do you think the market's reaction is going to be after the FOMC today? So definitely do join us in this poll. 411 votes. Participate. Vote. We're going to get to at least 1,000 votes before Powell takes a stand and starts talking. So definitely do participate there. I'm waiting for lower prices on Tesla. A lot of drama with Elon lately. Would you please analyze natural gas tendency? Will it grow resistance? So Andre, I'll do a more specific sort of video on energy. I'm going to do more respect to supply and demand for energy in general, whether it's oil or natural gas. But I can do something that's very, very quickly to kind of give you some technical overview of natural gas here. Let me just go over that very quickly. By the way, statements coming out in now under 4 minutes. So again, very, very important stuff. But natural gas, massive support here at around $2. And, that's exactly where we have kind of bounced off of April of 2023. So that's the level that I'd be paying attention to right now. Of course, very oversold at the moment with the MACD and the RSI as well. But there's a lot of other variables at play, right? Natural gas commodities are incredibly volatile. So you got to really know what you're doing if you are trading commodities or futures with respect to natural gas or crude oil or orange juice for that matter, or any other commodities. So Very, very volatile. Just be careful and understand how much you're willing to risk. Okay, so statement in under 3 minutes. Remember, folks, the market's pricing in unchanged policy, meaning rates are going to stay where they are. And 5.25 to 5.5% is what the market's pricing in, with a 96% probability that rates are going to stay steady. Okay, that's exactly what we are looking for. And this is the first meeting of 2024 of the 8 meetings that are going to happen in 2024 for the FOMC, with only 4 coming out with the summary of economic projections, with the actual predictions from the Fed. This is the first meeting of the year. That's why it's incredibly important, not to mention we've also got lots of earnings and unemployment Friday. So Friday, we've got the unemployment report coming out in the U.S., which has obviously been super strong. We've seen unemployment rates super low, unemployed persons super low, lots of jobs available in the U.S. For every one person that's unemployed, that's over 1.5 jobs available, which number has compressed. It's softened a little bit from highs of 2.5, but still, that still represents a very, very strong labor market. So there we have it. First meeting of the year. And definitely do, like I said, participate in the poll, like on this video so more people can join us. And I will be doing a lot of stock analysis for all of you after the statement's released. We'll talk about the statement a little bit, and then of course before and after the press conference, whenever you find the time. But I really want to keep it more macro focused. I will definitely go over some stocks for you guys that you are talking about. So Pinterest, Megan, I'll talk about it in just a minute. Jetto, we'll talk about SYM. We'll take a look at all these companies, but let's just focus on the statement and the FOMC first, and we'll circle back to a lot of individual stocks. So what I'll do here is I'll basically split the screen very quickly. So we've got the QQQs, NASDAQ composite here, 1.2%. I'm going to put the SPY up top on the left. So this right here is going to be the S&P 500. And then, of course, the yields are going to be down below. So this is the government yield, which is now trading under 4%. And we'll put the dollar index. We'll put the dollar index because it's been pushing higher since lows of 100 and 203. It's pushed up a little bit, back up to 103 here. So we're going to put that 5-minute chart over here. So there we go. The statement is coming out now. We're going to reload this page. There we go. Let's see. As soon as that comes out, we're going to take a look. 5.25% and 5.5%. That's what we're looking for from the statement, from the actual interest rate here. There we go. Let's see. As soon as it becomes available. There we go. So PDF. I click right here, and the rates are going to be, okay, committee employment. Okay, there we go. 5.25% and 5.5%. So no rate hike, no rate cut. Rate were unchanged. Yields, look at that. Huge pop in the 10-year treasuries. Back up to over 4%, almost 4%. The market's selling off even further. The NASDAQ here now down 1.4%. And the S&P down about 90 basis points, with, of course, a lot of Magnificent 7 and Core Tech selling off a little bit further. I do think that we're going to get bought up. I think that that's like, we don't really get a lot of information from this statement anyway. So what did the Federal Reserve tell us? Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have moderated since early last year, but remain strong. And the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. Exactly what we have talked about, because it's still above the Fed's target, especially when you look at core PCE. That's what the Fed's preferred measure of inflation is. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run, and that's their dual mandate. Low levels of unemployment, maximum employment, and low levels of inflation as well. And the committee judges that the risks to achieving its employment and inflation goals are moving into better balance. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. And in support of these goals, the committee decided to maintain the target range for the federal funds rate at 5.25% and 5.5%. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moved sustainably down to 2%. So this line right here is not what the market maybe wanted to hear, and we're selling off pretty aggressively. So that's actually quite an interesting line, which basically says the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down towards 2%. In addition, the committee will, of course, continue to reduce its holding of Treasury securities. That's what's happening from the balance sheet standpoint. They're rolling over their mortgage-backed securities and debt securities. And as described in previously announced plans, the committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook as well. It's kind of a shorter statement from what we have seen before. It's just like a one-pager. I'm sure Jerome Powell is going to be able to give us a little bit more guidance, but 2:30 p.m. is the speech, folks. So in less than 30 minutes is when the speech is going to happen. And the markets are certainly not liking the statement, because I feel like that that line right there, that the committee does not feel confident about reducing the range of the interest rates here. So this right here, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence. So really, I think what the press is going to be pressing on is what needs to happen for the Federal Reserve to get that greater confidence that inflation is moving sustainably down to 2%. And I think that's where the discrepancy is. Like I've mentioned this is a repricing risk, because if expectations are really high and the Federal Reserve under-delivers, that's opening the doors to disappointment. If the market was only pricing in, let's say, 2 or 3 rate cuts, and the Federal Reserve was a little bit more dovish, and they said that, 3 is good, that's what we've penciled in, but there is a possibility for us to do 4, 5, 6 rate cuts over the next couple of years, then that could be super bullish, and the markets can, start skyrocketing. But the problem is that we've already rocketed on the back of 6 potential rate cuts. So if there's any changes to that plan, if there's any changes to this potential plan, what the market's priced in, that is disappointment. As unfortunate as it is, and as I've mentioned before, that, of course, is not going to be great news from a Federal Reserve standpoint, from a market standpoint, more or less. So this is where we are. NASDAQ here dropping over 1.5%. We've got the SPY S&P down about almost 1%. And, of course, the dollar index with a huge spike back up to over 103.4, and the yields also jumping higher, back up to almost 4% right now. When it comes to individual stocks, we've got Google here, 6.5%. AMD, Nvidia still down over 2%. Microsoft and Amazon and Meta and Apple, all of them down over 1% at least. And then, of course, Tesla is down about basically flat, not really going anywhere. Netflix is the only stock that is still holding up a little bit better. So 25 minutes is when we have the Jerome Powell speech. In the meantime, again, if you have any questions, feel free to ask. Macro related, FOMC related, individual stock related. I'm happy to go over those. But yeah, pretty standard statement here. Interest rates unchanged. That's what the market was pricing in. But the real question was, what is going to be the path, the policy path to rate cuts? And that doesn't seem to be super bright, at least not right now. And that's a little bit of hawkish talk from the Fed, from the FOMC. We'll see what Jerome Powell says in under 30 minutes, but the bottom line is that they still don't know what the timing of those rate cuts are, because markets are pricing in the next meeting, basically the next meeting to be the first rate cut. And look, between now and the next meeting, we're going to have 2 inflation reports, 2 unemployment reports. We're going to have multiple GDP reports and estimates. We're going to have multiple 2 JOLTS reports, 2 unemployment. Like I said, we're going to have the Fed's balance sheet. We're going to have, consumer sentiment is going to come out. Consumer inflation expectations are going to come out. Earnings season is going to be done by March. So the Federal Reserve will definitely have a lot of data to work with in the March meeting than they have in this meeting, because we literally just got done with one of the important meetings, which was in December, right? So if you go back, the December meeting ended on the 13th, right? And today's the 31st. So we just had a little bit over 40 days, 45 days, about a month and a half. I didn't really have a lot of data to work with because this last meeting this happened after the inflation and the unemployment report. I believe inflation may have come out after this Fed meeting. But the bottom line is that we didn't really have a lot of data to work with for the Fed. So the next March meeting, when they do release the SEP, they'll already have 2 inflation, 2 unemployment, 2 JOLTS, 2 consumer sentiment, GDP numbers, estimates multiple times. So I think that will be a much better meeting for the Fed and much better estimates. Okay, let's take a look at some of the questions here. So what's your latest outlook on Enphase Angel? So I actually did a video on Enphase more recently, so definitely do check that out. But Enphase, as I've already mentioned, that I'm still dollar cost averaging. I picked up more shares, and the plan would be for me to hold on because I do believe long term this company still has a lot of potential. Yes, it's struggling right now. Yes, it's still in a bit of a downtrend. Interest rates are playing a big role for Enphase, and the third-party suppliers are also having an inventory glut where inventory is rising, and Enphase is kind of struggling to push through their product over to their suppliers because the consumer demand is slowing down on their end. So there's a lot of things to kind of focus here, but long term, I still do believe that Enphase has a lot of potential. Profitability is good, balance sheet's good, fundamentals overall seem to be pretty solid for Enphase. And Google video is going to be coming out later today, Chichi. So I will have that video posted after the live stream. So that is going to be going over the entire earnings breakdown, my intrinsic value, and long answer short, I do believe that this is a bit of an overreaction from the market on Google earnings because the company actually reported some pretty strong numbers. But hey, if they're giving us the opportunity, we are going to take it. So let's take a look here. Tomorrow, 3 of the Magnificent 7 earnings. Yes, so this is the earnings calendar. So we obviously already had Microsoft, AMD, Alphabet, and Starbucks report their numbers yesterday. Today, we've got Qualcomm. We had Boeing report pre-market. Then we got Align Technologies. And then tomorrow, super important day because Apple, 3 trillion, Amazon, 1.7, that's 4.7, and Meta is another 1 trillion, so it's 5.7, close to $6 trillion between these 3 companies alone that are going to be reporting their numbers. Same thing on Tuesday, right? So Microsoft 3 trillion, Alphabet's 1.5, or close to 2, so that's 5 trillion right there, reporting between these 2 companies, and AMD is about another 300 billion or so. So we did have a lot of companies packed for this week. And MasterCard, I actually didn't take a look at MasterCard's numbers because Visa reported last week. MasterCard seems to be pushing higher, 451, beat on EPS, beat on revenue. Is this a new all-time high? Yes. So MasterCard also with a new all-time high here with a very overextended overbought RSI at MACD at the moment. So I'll break down MasterCard's earnings when I find the time. But Friday, we've got energy, so Exxon and Chevron, along with Bristol Myers and AbbVie, as well as unemployment. So that's also coming out on Friday. Okay, do you own any oil stocks? I don't have any oil stocks here. So Aftab, what is your question? I'm happy to answer. Let me see what your question is. Thoughts on index investing during times that seem like they could be stagnant interest rates. So when it comes to index investings, regardless of the time, do it. Just do it. That's kind of like the foundation of your portfolio, in my opinion. And, of course, individual stock picking is fantastic. It's great. Like, obviously, it requires a lot of time, a lot of active involvement. But index investing and ETFs, I feel like, are kind of like the bedrock of every portfolio. They reduce volatility. They're kind of there to help you with a portfolio construction that's, you don't really feel those psychological issues of having that fear of missing out, right? Because even if you are, let's say, not in any particular stock or sector, at the very core, if you have, let's say, something that's broad-based, ETF or index, you'll always feel like you're part of the market that's actually moving higher or lower. And when I say reduced volatility, if you take a look at how much the S&P went down in 2022, 25% from all-time highs, versus a lot of individual stocks that were down 40, 50, 60, 70, 80%. So in my opinion, I think whether it's a small portion or a big portion, I think index investing or broad-based ETFs or low-cost ETFs are something that I think everyone should consider. Of course, depends on a lot of different variables such as your time horizon, your objectives, your goals and whatnot. But for me personally, the way I've structured it is that I do have a pretty decent chunk of the portfolio in ETFs like VUG, SMH, Cyber. And then, of course, the rest of it is in swing trading and individual stocks and options trading. So that's the way I've kind of balanced it out. So I think it's really important to have at least some exposure to just broad-based ETFs, indexes. Akash, what about PayPal? I mean, PayPal has obviously been struggling. We had the Innovation Day, just waiting on the actual earnings from the company, from Alex Chris, and what 2024 is going to look like. With PayPal, we've already, looked at the earnings and the fundamentals. I mean, the company is solid. I mean, there's not really been any issues. The only concerns obviously been with respect to competition and, what could happen with PayPal. none of that has materialized yet because the revenue and the earnings and the profitability has still been pretty solid for the company. So we'll see what happens under the new management for PayPal. So we'll be on the lookout for that as well. Okay. So overall, markets here recovering a little bit back higher. So we did see a drop on the back of that statement from the FOMC, and are starting to see some buyers step back in. But I still want to know from all of you, so definitely do vote and participate. 616 votes right now. Folks, we only need 384 more votes so that we can actually get to 1,000 votes. What do you think the market's reaction will be after Powell's speech? Okay, not before we're already selling off, not during, after he's done talking. Do you think the markets are going to be bullish and we can end the day green? Or do you think we're going to continue to slide lower and end up down, or be maybe neutral on the day? So Byron, is the conference from Powell typically more impactful than document release? Yes, it is almost always more impactful. The only thing also to consider is that the summary of economic projections, which is another document, which is the SEP, was not released in this meeting because it was not scheduled for release this meeting. It's scheduled release for March. That's when they'll update all these projections. So if the statement is accompanied by this SEP, then this definitely has a much bigger role to play. I would say equivalent to the press conference from Jerome Powell. But when this document is missing, like we just had, because they weren't scheduled to release this today, then the summary, then the actual speech itself is going to be a lot more important for sure. So Duncan, a young age without a lot of capital, do you still think it's important to have ETFs? To be honest, I don't have any ETFs. I'm invested only in stocks and feeling kind of good. So it depends, right? I mean, everyone's got different strategy. If you are young, then of course your risk tolerance is going to be much higher. If you're working with, let's say, not a lot of capital, then I still look back, like, let's say that you're working with, $5,000 or $10,000 or $20,000. You've got, and of course you've got lots of years of your prime working years are still ahead of you, and you're younger, right? So you can take on a lot more risk versus somebody who's, let's say, in their mid 40s that has a couple $1 million portfolio. They can be looking at, investing in individual stocks, unless of course they've done their entire life, and that's really what their expertise is in. They're looking for more sort of like safety, and they don't want to take on too much risk. All they really want to do is maybe match the market or slightly get 200 basis points above the market. So it's like different strategies for everyone. I've talked to people that have really stressed themselves out over trying to beat the market, when in reality they really don't need to. Okay, again, just focus on the choice of words here. They sure want to, but they don't really need to. I mean, I say they don't need to, is that everyone, what they need to do, step number one is to figure out how much you actually need, right, for when you want to retire. And once you figure that out, then you just have to bridge the gap between how much you need and how much you have. And then you just kind of calculate, okay, this is how much I need, this is how much I have, this is how much I need to sort of achieve on a yearly basis, on a return basis, to get to my goal. And that's it. That's your financial plan, right? That's literally your financial plan. And if that number, that percentage rate that you need to achieve every year is 7% or 5% or 12%, then you tailor your strategy according to your percentage goal. A lot of people shoot for the stars, 20%, 30%, without realizing the higher you reach for those higher returns, the higher you're going out on the risk curve. You're taking on more and more risk to achieve a higher yield, because nothing comes for free. A portfolio generating 10% versus a portfolio generating 20% are completely different on their risk profiles. One is taking huge amounts of risk, the other one maybe not so much. So, risk is something that oftentimes people forget. They don't account for it because everybody's looking at the returns. Everybody's like dangling the returns in front of them, like Kathy Wood, like, oh, we made 40% this year or 70% this year. Oh, this portfolio made 80% this year. Yeah, by taking on an insane amount of risk. And that doesn't always work out. So you want something that's more consistent, more predictable, because you don't want to be blown out of the market because you'll get wiped out fairly quickly. And that is the worst thing to do if you're trying to build up your confidence early on. So anyway, so going back over, let's see, what's my predictions for Amazon earnings? We'll be doing a video on Amazon as well. But I think Amazon is now really focusing on profitability. So earnings wise, almost 80 cents per share, 165, 166 billion. And if you compare this to last year, so February 1st, yeah, so that's going to be pretty solid growth in revenue, and EPS is going to be up like 400-500%. So it's possible that the company actually does end up reporting some pretty solid numbers, beats on both revenue and EPS, and that could be pretty solid for the stock. Mario says 70% VOO and 30% individual stocks. That's fantastic. That's amazing. Good balance, and of course, you can also have that flexibility with that 30% to kind of generate that additional returns that you want along with VOO, right? So tested at 155 or has found a good support at 180 area. So 180 is the support. That's the level that we have talked about initially, right? That was a lower low. This is the overall downtrending channel of lower highs and lower lows. Support level is going to stay put down to $180. So this is, oversold RSI, oversold MACD. If you do get a bounce back higher, it's got a potential back up to $200, even as high as 240, 250. But that is that first level of support of 180. If it breaks down, then we'll be watching 150 down below. Srinivas, hi Gadi, how are you doing? Thank you so much. Srinivas, I'm doing well. Can't complain, so thanks for asking. Lucid, I will take a look at that here as well. Yeah, so unless you get paid to analyze companies full time, the bulk of your money should be in S&P 500. Yeah. So really, I mean, it's not super complicated, because I started that experiment in VUG 2 years ago, just to see that even if you buy it at the worst possible time, and that's the beauty of index investing, right? You don't have to worry about timing the market. You don't have to worry about where's the market trading, what's the interest rates doing, what's the Federal Reserve doing, right? So I started that experiment 2 years ago, bought it at the worst possible time, and that was the idea, that I wanted to buy it at an all-time high when prices were at their highest, valuations were extreme, and just consistently dollar cost average my way in on that ETF. 2 years, fast forward 2 years, kind of went through that entire bear market, and I went through that entire recovery in 2023, and now that position's up like 12-13% from those cost basis levels. So as long as you're looking at dollar cost averaging into broad-based ETFs or indexes or even high-quality companies, over time the markets will recognize that. Same thing happened with Supermicro Computer. As a community, I'm like super proud of that stock, because in just a matter of 10 months, that stock has rallied over 560%. This is a company that was very much under the radar. It was not something that was being talked about or looked at all. Like quite literally, if you go back to March of last year, nobody knew Supermicro Computers. And we talked about it because multiples were so cheap for the earnings growth potential for this that it just did not make sense at where it was trading at $93, $94. So markets will eventually recognize that, right? They will reward you for your patience, for your quality assessment of companies and ETFs that you're looking at. Another thing to really look at is if you have a more than 15-year time period of investing in the markets, and this only applies to the US and S&P 500, does anyone want to take a guess of the probability of you being profitable if you are investing for more than 15 years in the S&P 500? So let me rephrase that question. If you invest in the S&P 500 for 15 years or more, what is the probability that you will make money? So let me know in the comments. I want to see how many people can actually know this stat. So again, the question is, if you invest in the S&P 500 for 15 years or more, what's the probability that you make money in the S&P 500 when you invest for more than 15 years? So Majur says 100%. Nothing's 100%, my friend. But okay, 100%, couple 100%. So let's see. Sanjeev says 99%. I want to see more people participate. I want to see what other people are thinking with respect to this question. I want to see. So okay, Pradesh says 100%, 100%. Peter says 90. Long run's better, 90%, 50 years, 15 years. Fernando says 98%. By the way, press conference starting in under 8 minutes. I'll do an audio check here in a couple minutes here, and then we'll just make sure that everything is working well. 75. We'll wait for a couple more minutes until more people participate. 98, 95, 98. Okay. So the answer is 99.5%. Okay, so most of you guys are correct because everyone's saying over 99%, 98%. So yes, 99%, 99.5 to be precise is the number. That simply means that like 15 plus time horizon, again, nothing's guaranteed, but the probability is extremely high for you to actually make money if you just simply consistently dollar cost average into an index or an ETF. 0.5%, that you lose money, and that 15-year period could be during the Great Depression or the dot-com bubble, and that's also like really, really low probability there. So yeah, almost 100%. So yeah, 99% is the correct answer. Correct. So yeah, that's the idea, right? Long-term things tend to play out, but the only concern of, as I've mentioned before, that nobody has any answers to is the debt levels and what the end game looks like with respect to the amount of debt that there is in the world, and more specifically in the US. Because there's expectations that the debt level is going to approach 50 trillion, 52 trillion by 2030, 2032. And nobody knows what the end game looks like for the dollar and for the debt levels that the US has. So that's the only sort of concern. If you take that equation out, then I would be 100% without a doubt long and bullish on the US and US stocks. But it's just that debt is something that kind of I have no idea like what that end game is going to look like with that level of debt. So, but of course, if anybody has the answer to that, I'm all ears, because that's a big problem that we need a solution for. Anyway, everyone, make sure that you drop a like. I would really appreciate that. 710 votes right now. We need just 300 more people participating in the poll right now, so we can get to 1,000 votes here in under 6 minutes is when Jerome Powell is going to be coming online with his speech. I'm going to do an audio check here, but the NASDAQ rotating back lower, down almost 1.6%, with the S&P down over 1% now. The government yields are trading just under 4%, and of course, all Magnificent 7 and technology stocks down, except for Netflix, which is slightly higher on the day today. Peter says yes, but not losing money means that you can also have 1% per annum, which is, as you often say, nothing to write home about. Yeah. So in the long run, we all die. He said that. Yeah, I know. I've heard that as well. So quick technical overview on Palantir. 1 second. Dropped my pen. Okay, Palantir. Let's just quickly take a look before the speech begins. 5 minutes. But this right here is the overall technicals for Palantir. Much stronger support at $14. So this right here would be the area, so inside this green rectangle. And of course, a resistance all the way up to $19 to $20 per share for Palantir. Lots of consolidation in that range for Palantir. So we're seeing a lot of sort of sideways action for the stock here. And like I said, support level is going to stay put down to 14.22. Apple not here. Low 160s, and I'll be adding a lot more Apple at the moment. Okay, folks, so we're gonna have this live stream started very soon. There we go. This is live. I'm gonna do a quick audio check once Jerome Powell starts talking. So just let me know. Just give me a thumbs up if everything is working well. And what we're gonna do is we're gonna sort of make this smaller, and we're going to put this right next to the charts. As you guys already know, that's the drill. That's what we like to follow. So we're going to put that here. Perfect. So that's what it's going to be like. And then, of course, we'll have the NASDAQ here. We'll put the SPY, S&P 500 down here. Take a look at the market's reaction. And we're all set. I'll do an audio check in just a couple minutes. And we are ready to go. We are ready to go here. Ready? Okay, so I want to see who also voted bullish versus bearish. So type 1 in the chat if you are bullish for this meeting, and 2 for bearish. Okay? 1 in the chat if you are bullish for Jerome Powell's speech and the market's going to be ripping higher here on the back of whatever Jerome Powell has to say. And 2, if you believe that we're going to see a lot of bearish momentum, we're going to see that continued sell-off in the markets after Jerome Powell is done talking. So 1 or 2, 1 for bullish, 2 for bearish, 1 for bullish, 2 for bearish. Comment down below. Okay, see a lot of 1s here popping out. So people are in general more actually bullish bearish quite neutral here. 38%. That's actually quite crazy. That's 750 votes and it's literally dead split. 38% between bullish and bearish. We know who's short, we know who's long. It's like half of you are expecting for the markets to rip higher and half of you are shorting this market right now, expecting for a bigger sell-off. 3, market stays flat. So yeah, 2, now lots of 2s are coming in. So we'll do an audio check again in a couple minutes here as soon as it starts. And we should be all set and all ready to go. Market's not looking super great on the day today. And I think that's normal considering how much we've already rallied kind of heading into 2024. So I don't think it's what color tie? Kevin's asking. I think purple. My bet's on purple. He's been going with purple a lot. He's not really wore like red or blue in a long time. So I'm going to go with purple today. Maybe that should be our next poll. By the way, folks, 800. 800 is our target before the actual press conference begins. So in 1 minute, 40 more votes. Definitely do participate so we can get up to at least 800 votes here. And we are ready to go. We are good to go here. So my vote, I think we're going to be a little bit more on the bearish side because I feel like Powell's going to be somewhat hawkish today. I'm feeling hawkish. So it's possible that maybe Jerome Powell is not feeling super generous either. But we'll see. We'll see. Okay. I'm gonna shut up my mic here. I'm gonna turn. Let me know in the comments if it's working well, okay? Should be. As soon as it starts. Just let me know on the audio, right? As soon as he starts talking, let me know if the audio is good. Purple tie.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objectives. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Sheena Smilik from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay, so what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and it has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example. And goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down. Growth has been strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or experience. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our teal book and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see, the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above. Core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline, and the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates? Yes.
So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did, talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents. So, of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, you know that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you. Sorry. Thanks for taking the question, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market. I think you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back, and that's okay. That's okay. But we do see. You saw today's ECI reading. The evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. The panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And, one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk. The risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months. But what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. We'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, right. I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is
is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity? And do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall? That maybe there's just a higher level of productivity.
That's
right
one
now?
way to look at it. Yeah.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built up set of cities and people are moving further and further out. So there's there hasn't been enough housing built, and these are not things that we have any tools to address. But you know, where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation in the necessities of life, right away you're in trouble. Whereas even middle class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and we're focusing on them, but we're at the beginning of that process, I would say.
Quick follow-up. Is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to zero, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to zero. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting, a whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a third term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that inflation that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point. Is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And, do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years, but nonetheless that's been the case, and we've asked ourselves why that is, and one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Manessian in business. Committee members have said they like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy. And I always feel like I spent most of my life in the private sector looking at companies, individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone, that in all their districts, they're talking to, not just the business community, but the educational, medical, nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is during the Outlook go around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk up, they will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation, are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right, folks. So overall, I would say it was a little bit more on the hawkish side. The markets did recover a little bit, as he did mention that we are achieving greater confidence over time, because I think 6 to 12 months of inflation showing signs of progress, according to Jerome Powell. But I've got a lot of notes to digest and summarize for you. So that'll be up next. But once again, thank you so much for joining us for this live stream. I really appreciate all of you. And I'll be putting out a couple videos on AMD earnings, Google earnings. We've got Microsoft earnings also to break down. And then, of course, tomorrow we've got Meta, Apple, and Amazon. And this summary video is going to be released soon as well. So thank you so much for joining. Really appreciate it. As always, make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining. And again, as always, happy investing. I'll see you all in the next